Just this quarter, something shifted beneath the surface of the global economy, something the Pentagon has feared for decades. While you were watching the day's headlines, China began quietly dumping billions in U.S. Treasury bonds. Now, the official story you might hear is that this is just a routine financial adjustment, a simple portfolio rebalance. But that's not the truth. This is a deliberate move, a financial shot across the bow. It's a decision that will directly impact your savings, your mortgage, and the value of the dollar in your pocket. This is far more important than any election or political scandal you've seen this year. So why are they doing it now? The real reason is a quiet warning Washington sent 2 years ago, a warning they hoped everyone would ignore. This isn't just a headline for Wall Street. This is about your wallet. For over 40 years, America has run a massive credit card tab with the world, and China has been our biggest lender. Their constant buying of our debt, over $1.3 trillion at its peak, helped keep interest rates artificially low. That means your mortgage, your car loan, your student debt, the cost of all of it was subsidized by this system. But now the biggest buyer is cashing out. Think about what happens when your main source of credit dries up. You have to pay more to borrow. The United States now has to find new buyers for its debt, and those buyers will demand a higher price. That price is higher interest rates for you. We're talking about a fundamental shift that could make everything from buying a house to starting a business more expensive. The economic stability you've always known is cracking. But how did we get here? How did the American dream become so dependent on the decisions made in Beijing? To understand what's happening now, you have to go back to 1971. That's when President Nixon severed the dollar's last link to gold. This single decision created what economists call an exorbitant privilege. The world needed dollars to trade, to buy oil, to survive. And the United States could print them, running a massive national credit card tab for over 40 years. But who was paying the bill for this endless spending? Enter China. As the world's factory, it sold mountains of goods to American consumers, and in return, got flooded with U.S. dollars. But what do you do with all that cash? You can't just stuff it under a mattress. You have to invest it. For decades, the safest, biggest, and only real option was buying U.S. Treasury bonds. China became America's biggest banker. At its peak, Beijing held over $1.3 trillion of American debt. Think about that. China was lending its main geopolitical rival the money to fund its military and run its government. On the surface, it looked like a perfect loop. America got cheap goods and cheap loans. China got a massive customer and a safe place for its savings. Everyone wins, right? But that simple story hides the truth. This wasn't a partnership of equals. It was a system with a hidden lever of power, a financial weapon hiding in plain sight. So why would China bankroll its biggest global rival for decades? A neat, tidy loop. A symbiotic financial relationship. It worked like this. Step 1. Chinese factories produce nearly everything. The phone in your hand, the sneakers on your feet, the television on your wall. Step 2. You and millions of other Americans buy those goods using U.S. dollars. Step 3. Those dollars, trillions of them, flood into Beijing's central bank. Now, what does a country do with a literal mountain of cash? You can't just stuff it in a vault. You have to invest it. And for decades, there was only one place on earth, big enough, safe enough, and liquid enough to absorb that kind of money: the United States Treasury market. Think of it this way. Imagine you run the most successful business in town, and every single month you earn a truckload of cash. But there's only one bank in the entire region. It's massive, it's secure, and everyone uses it. You don't particularly like the bank manager. In fact, he openly calls you his main competitor, but your only other option is to bury the cash in a field where it loses value and could be stolen. So you deposit your money in his bank. You don't do it because you're friends. You do it because you have no other choice. For China, America was that bank. At its peak, China held over $1.3 trillion in U.S. debt. That's more than the entire annual economy of Mexico or Indonesia. This wasn't a partnership of equals. It was a gilded cage. The money you spent on a new laptop was effectively loaned back to the U.S. government, which then used it to fund its massive deficits. China's own success was being recycled to finance the military and economic power of the very country that saw them as a strategic threat. But this forced dependency had a hidden cost, a ticking clock built into the system from day one. And when you calculate the true price China was paying, you see exactly why they had to find a way out. The numbers don't lie. At its peak, China held over $1.3 trillion in U.S. Treasury bonds. To wrap your head around that number, think of it this way. It's more than the entire annual economic output of countries like Australia or Mexico. It's enough money to buy Apple, the world's most valuable company, with hundreds of billions left over. For decades, that massive holding was the bedrock of the global financial system. But look at the numbers today. According to the Treasury Department's own data, China's holdings have plummeted, now sitting below $800 billion. Let's do the math. That's a sell-off of more than $500 billion. $500 billion in U.S. debt. Systematically unloaded. This isn't a minor portfolio rebalance. It's a strategic retreat on a historic scale. So what triggered it? The answer can be found in a single chilling number from 2022 to $300 billion. That's how many dollars of Russia's central bank reserves the U.S. And its allies froze, almost overnight. Put yourself in Beijing's shoes. You watch your primary global rival seize $300 billion from another nation. Then you look at your own balance sheet, holding over $1 trillion in that same rival's debt. Suddenly, that investment looks less like a safe asset and more like a $1 trillion hostage. The risk became a mathematical certainty. The calculation was simple. Reduce exposure. Fast. A 40% reduction in holdings isn't a market fluctuation. It's a calculated exit strategy playing out in real time. The numbers don't lie. The motive is crystal clear. But what actually happens when the world's largest foreign creditor cashes in $500 billion of your country's debt? When that pillar of the financial system is deliberately pulled away, the fallout isn't a single event. It branches into a few distinct and deeply unsettling future scenarios. So what does a world with fewer Chinese buyers for U.S. debt actually look like? Two very different futures are possible. Let's call the first one Scenario A, the slow burn. This is the most probable outcome. China continues to gradually, almost silently, reduce its holdings over years, not months. They don't want to crash the market, because that would devalue the hundreds of billions they still own. In this future, the U.S. Treasury finds other buyers. Maybe Japan, maybe the UK, maybe even American investors. The impact on you? Interest rates might slowly creep up. Your next mortgage, your car loan, the nation's debt, it all gets a little more expensive. It's a managed decline, a headache, but not a heart attack. Then there's Scenario B, the financial nuclear option. This is the stress test, the low-probability, high-impact event that keeps strategists at the Pentagon awake at night. Imagine a full-blown crisis over Taiwan. In this scenario, Beijing decides to weaponize its holdings. They dump hundreds of billions of dollars in treasuries onto the open market all at once. The goal isn't profit, it's chaos. Panic would rip through global markets. The value of the dollar could plummet, and U.S. interest rates would have to skyrocket to attract new lenders, potentially triggering a deep, painful recession. Now, to be clear, the slow burn is overwhelmingly more likely, but the fact that the nuclear option is no longer a 0% probability is what has changed everything. Of course, there's another argument, a powerful one. It says China can't really hurt the United States. That for all this talk, they're trapped in a dollar-denominated prison they helped build. Now, I know what some of you are thinking. This is just noise. It's being blown out of proportion. The argument goes that China still holds nearly $1 trillion in U.S. debt. They would never torpedo the very system their own export-driven economy was built on. It would be financial suicide. And for decades, that has been the conventional wisdom in Washington and on Wall Street. It's a fair and logical objection. But this argument misses the bigger picture. It's like noticing a ship is still afloat, while ignoring the crew that's been quietly lowering the lifeboats for years. Let's look at the hard data from the U.S. Treasury itself. Yes, China still holds a massive amount, around $800 billion in Treasury bonds. But just a decade ago, that number was over $1.3 trillion. That's a $500 billion reduction, a drop of nearly 40%. This isn't a minor portfolio adjustment. It's a deliberate, strategic retreat executed over 10 years. It's slow enough not to cause a panic, but fast enough to be unmistakable. The motive isn't a mystery either. When the U.S. and its allies froze $300 billion of Russia's central bank reserves in 2022, It sent a shockwave through every capital city not firmly in the American camp. For Beijing, it was a fire alarm. It proved that dollar assets are not neutral financial instruments. They are a weapon. And China realized it had over $1 trillion of its national wealth sitting inside the armory of its #1 strategic rival. So the data tells an undeniable story of de-risking. A quiet, methodical exit. But the numbers only show us the times what. They don't reveal the mindset behind it, or the true endgame. And my analysis, after looking at this for years, is that this isn't just about playing defense. So what am I doing with my own money? First, the mandatory disclaimer. I am not a financial advisor, and this is not a recommendation for you to buy or sell anything. This is simply me, thinking out loud, sharing my personal playbook for navigating what I see coming. For me, this isn't about panic. It's about prudence. I'm treating this as a long-term insurance policy. I've allocated a small 5% slice of my portfolio to assets outside the traditional dollar system. Think physical gold and a small position in Bitcoin. This is my hedge. My position sizing here is critical. It's small enough that I can sleep at night, but meaningful enough to matter if the system truly fractures. My primary trigger to increase this allocation isn't a stock market crash. It's geopolitical. The moment we see another G20 nation's central bank reserves get frozen, that 5% allocation could double overnight. It's a clear signal the rules have permanently changed. But here's the paradox. While that long-term hedge is in place, I'm watching for something else entirely, something that seems to defy all logic, because the very forces that could break the dollar in the long run might first trigger the most violent, face-ripping rally we've seen in a decade. The great unwinding has finally begun. For over 40 years, a fragile financial loop allowed America to live far beyond its means. That system is now breaking. This isn't just China selling off some bonds. It's a quiet declaration that the era of America's exorbitant privilege is ending, piece by trillion-dollar piece. Think of it like this. You are standing on a shoreline, and you've just realized the tide is going out fast. This is the financial equivalent of watching the Berlin Wall fall, but it's happening in slow motion, right on the balance sheets that underwrite your savings, your retirement, and your future. The consequences won't wait. To navigate what comes next, you need a new map. Subscribe and hit the bell, because our next investigation reveals the one-size asset class the world's central banks are quietly stockpiling to prepare